Oh boy, this is going to be so much fun. Why? Because we are about to embark upon a journey of discovery. And we're going to try to figure out how to put a value on common stocks, on the price of the stock, the price of the company. What's the company worth? And we're going to find that it's not easy, dear students. So let's start with a couple of quotes from very smart people. And this first one, I always like to remind myself when anybody talks about the price of a company or the stock price, and look what it's doing. I remember what Greg Ireland, long since retired, a mutual fund manager with over 35 years of experience, said, "Value matters. You ignore value at your peril." Yeah. Especially with what we've seen with GameStop and other companies where they don't care about the value. All they care about is knocking the price down or knocking the price up. And Sir Arthur Conan Doyle, through his famous character Sherlock Holmes, it is a capital mistake to theorize before one has data. So we're going to take a look at the data and theorize and realize that it's still not very easy. We're up against it, folks. But you're going to find, I think, that if we follow some of the techniques we learn here, we will tilt the odds in our favor toward companies that will make us wealthy over the long term. I think I've already said that once or twice, and I'll probably say it a whole lot more times before we're through. Slide number 2, common stock valuation. The process by which the underlying value of a stock is established on the basis of its forecasted risk and return performance. At any given time, the price of a share of common stock depends upon investors' expectations about the future behavior of that security. In other words, what do people think is going to happen in the future? A fundamental assertion of finance holds that the value of a stock is based on the present value of its future cash flows. And cash flows come from earnings and dividends. So the worth of a company is primarily based on the earnings and potential dividends the company will produce in the future. But if we knew what was going to happen in the future, we wouldn't call it the future, would we? Prediction is difficult, especially about the future. So here's from the Random Walk Down Wall Street, a book you should read by Professor Burton Malkiel. The most fundamental influence on stock prices is the level and duration of the future growth of earnings and dividends. However, future earnings growth is not easily estimated, even by market professionals. So if someone were to ask you, what is the most important factor in determining the future value of a company? In a few words, you could say future earnings or future dividends. But do any of us know what's going to happen in the future? No. So is valuing stock going to be easy? No. It's downright hard, as we shall see. Slide number 4, security analysis, the process of gathering and organizing information and then using it to determine the value of a share of common stock. What we're looking for, and you'll hear people use this term, the intrinsic value, the underlying value, that's what we're looking for, determined through high quality analysis, through security analysis. Well, the question is, what security analysis methods or measures does one use to determine the intrinsic value of a company? Future dividends, potential capital appreciation, price to earnings ratio, financial ratios, past performance, the amount of risk. Value, like love, is in the eye of the beholder. Yes. So we are going to start what is called fundamental analysis. Well, actually, we did a little bit in Chapter 5 when we looked at a few of the measures that we discussed, PE, dividend yield, the payout ratio. Fundamental analysis is the examination of a firm's accounting statements and other financial and economic information to assess the economic value of a company's stock. Some examples of the fundamentals are the competitive position of the company. Is it Coca-Cola or Pepsi-Cola? Or maybe it's Monster. The growth prospects for companies and its market, the profit margins, the company's earnings, what assets are available, the company's capital structure, which is a fancy way of saying how much debt they have, how much equity, how much do they own. Simply put, the value of a stock is influenced by the performance of the company that issued the stock. Now, doesn't this make sense? I mean, it just makes perfect sense. Wait a minute, there are other people who think, no. They don't even care about the fundamentals. They are called technical analysts, and we will look at them later on and why they're all wet, in my humble opinion. But of course, that's why there's chocolate and vanilla, and some people like strawberry. People will say, no, Piano doesn't know what he's talking about. Technical analysis is fabulous. Let me show you why. So it's up to you, dear students. You're going to see both sides. And then there's a third side that we'll discuss later on. Slide number 6. Slide number 6. Financial ratio analysis. One method of security analysis involves looking at certain financial ratio measures. Financial ratios give us a quick and easy method for comparing one company to other companies within their industry or the stock market as a whole. The problem with financial ratios is that there is no single financial ratio that can adequately sum up or summarize the general state of affairs, situations, predicaments, etc., that a company finds itself in. The first financial ratios we will investigate will be what are called the price ratios, and we'll look at others later on. Well, we've already looked at one, right? We looked at the price to earnings ratio. And as we said, you can't just use one ratio. You can't just say, this is the reason I'm going to buy the company. You have to look at all of them. You have to look at them in the context of their competitors and the market as a whole. So you'll hear people key on price to earnings ratio, and it's very important, but it's not the only one. Speaking of which, let's review. What is the price to earnings ratio? Well, it's a very simple calculation. You take the market price of the company. Let's see if we got we do. Market price of the company divided by the earnings per share. So you'll hear people call it the PE, P/E, and it's the most popular market statistic. Historically, PEs were in the 5 to 12 range for mature companies and 14 to 20 range for growing companies. Greater than 20 was unusual. In the late 1990s, and now, it was and is commonplace. As we said, some are astronomical. But we'll find that PE ratios are all over the map. And check out Shopify and TJX, the company that owns TJ Maxx and a few other stores. But here are 5 different companies that you probably all have heard of: Toyota, Target, T-Mobile, Tupperware, and Tesla. And the only thing they really have in common is that they start with the letter T. But let's take a look at their PEs as of February 26, 2021. Toyota, one of the world's largest, if not the largest, world car manufacturers. It's GM, Toyota, and Volkswagen, and they all sort of vie for the largest in terms of cars sold. Has a PE of 9, very respectable. Target, 24. T-Mobile, 45. Tupperware, you remember them, 83. And price to earnings ratio of Tesla as of February 26th was over 1,000. Now, I think it's come down quite a bit because the price of Tesla has gotten hammered in the last week and a half since we put these numbers in the presentation. What can we glean from this? Well, I'll tell you what I think. Some people are nuts. Some people are bid up the prices of a few, more than a few companies to astronomical levels. My money who's going to do the best in the next 10 years out of these five? Oh, I don't know about Target. Target's an unusual company, but out of these five, I think Toyota is probably going to do the best. Why? Because they're just not going to fall as much as the other companies. But we'll see. That's why they call it the future, right? Yes. Who would be your choice? Just on PE alone, right? Again, I just told you can't just use the PE as your choice, as your reason to choose a company or not choose a company. So, historically, as we said, a company's PE ratio was supposed to match its growth rate. That's the way it was supposed to work. It doesn't work that way for many companies now. If the company was growing at 20% a year, then a PE of 20 was justified. And 20%, that doesn't sound like much, but if you were growing at 20%, in a little over 3 years, you'd be twice your size. During the internet bubble, many companies had PE ratios in the hundreds, and some companies do now too. I'll never forget looking down at the Quotron machine. You don't even know what that is, right? Quotron. That was just the internet was just getting started, but before that, stockbrokers used a communication system called Quotron. eBay's PE was 10,000, and I thought, this isn't gonna last. I didn't know when it was gonna stop, but I knew it ain't gonna last. Growth stocks typically have high PE ratios. Value stocks typically have low PE ratios. But please go back if you don't remember our discussion of growth versus value and the way people use the terms in the industry. A value stock might not necessarily be a good value, and a growth stock might be a good value. The PE ratio tells you how long it will take in years, assuming no changes in earnings, for the company to earn back its price. A PE of 3 means in 3 years, assuming nothing changes, and it changes every day, it'll take 3 years. A PE of 20, 20 years. A PE of 10,000? Yeah, we were worried about the Y2K problem back then in the late 90s. These people have to worry about the Y5K problem when we go from the year 9,999 to the year 10,000. We don't have to worry about their students. We will all be comfortably dead. Slide number 9, price to cash flow. Well, it's the same idea, folks. The price to earnings takes the price and divides it by the earnings. The price to cash flow takes the price and divides it by the cash flow. Now, you might say, wait a minute. How could the cash flow of a company be different than the earnings? Well, there are several reasons, but the major reason for many companies is depreciation. Because you accounting students know that you don't write a check to depreciation, but it still allows you to reduce your earnings and pay fewer dollars in taxes. So depreciation is not an actual cash expenditure, so it will often be higher than the earnings. But not always. You'll hear people talk about good quality earnings versus poor quality earnings. During the internet mania, and now for some companies, many companies were reporting record earnings, but at the same time their cash flow is negative. Well, wait, how could that be? How could you be earning tremendous sums of money and at the same time your checkbook balance is going down? Well, it's actually very simple. And a great example of this is Lucent Technologies. You old-timers will know it as Bell Labs and Western Electric. It was the arm of the old AT&T that actually did the research and built the equipment. And they were spun off from AT&T, I think, about 1990 or so. Well, who builds the best telephone equipment in the world? Well, at the time, it was Lucent Technologies. And of course, all these new startups in the telecommunication industry are needing telecommunication equipment. So they go to Lucent Technologies and say, would you sell us $100 million or $2 billion worth of telephone equipment? You know, we're this great startup. We're going to be big, big, big. And Lucent says, sure. And the company says, but you know what? We don't have any cash. Will you be our bank? Because the bank won't lend us $100 million or $2 billion. And Lucent says, sure. They build the equipment. they sell it to them, but they only get a tenth of what the price is. The rest is owed to them. You see what's going on here? Lucent is now the bank. And these people are going to be paying Lucent over the next 10, 20 years, 30 years to pay back the equipment. And then the next year they promptly go out of business. Lucent gets the equipment, but it's already out of date. They can't sell it. And Lucent Technologies almost went bankrupt. Yeah, they did. They wound up surviving. I think it was 80 cents at the bottom, and I told myself, they're going to survive. Maybe not. I don't know. And they did survive. And then they merged with another company, and I forget what the name of it is. Lucent Alcatel, I think. It's a French company. Maybe not. Maybe they're already gone. Check it out. Slide number 10, price to sales ratio. The current price divided by annual sales. So instead of earnings, instead of cash flow, we use sales. Historically, a higher price to sales ratio suggested a higher sales growth, and a lower price to sales ratio suggested a lower sales growth. And during the internet mania, many analysts started using price to sales instead of price to earnings, since most all the new companies never generated any earnings and their cash flows were negative. How did that work out? Well, many of those companies are gone, but a few have survived. Yes, they have. Slide number 11, and then price to book ratio. This is a statistic that I think I asked you to look it up in chapter 5, called the book value. Historically, if the book value was greater than 1, then shareholders believed that the firm was creating value above and beyond the physical assets of the corporation. And that makes sense, doesn't it? If you look at a pizza shop, the value of the assets, it's really not that much compared to the value of the store, because the store, the restaurant is in business to make money, and so people look at the earnings as opposed to just the value of the assets. And now it is very rarely close to the price of the stock. It is typically 3 or 4 or 5 times, or sometimes a whole lot more than the book value, what it is worth on the books, as the accountants like to say. Now, what happens if the book value goes below, the market value goes below the book value? That means investors believe this company's going bankrupt, and they're not interested in it. They're selling the stock, and now the stock price might be less than the value of the assets on the books. And if the value of the assets on the books really are worth what the accountants say they're worth, it is typical for corporate raiders, private equity, takeover artists to come in and swoop up all the shares, sell off all the assets, pay off the debtors, and walk away and liquidate the company. And so if you're an employee, you're not too happy because you've been working here for 22 years and now you're out of a job. And so you scream and holler to your congressperson about how horrible these people are. But the economists and the corporate raiders, if they deem to talk to you, will say, you don't understand. This company was dying. That capital, those resources, needed to be unlocked and spread out and found and to be utilized in newfound areas where it does make sense. And that's why there's unemployment insurance, dear students. Don't let anybody tell you there's unemployment insurance to pay people not to work. No. It's because we want those companies that are dying to go bankrupt, to go away. And we want that capital, including the human capital, including the people who are working there, to find more productive, more economic, more ways to boost the economy. I know it sounds like an ad, I apologize, but it's not perfect, but that's how it works. Slide number 12. So, okay, Payano, now that we know about these price ratios, how do we use them to predict future stock prices? We multiply an historical price ratio by the expected future value price ratio denominator. It's actually easier to do than it is to understand, which is why throughout this chapter, you're going to be doing things and not really understanding why you're doing them and what you're doing, but just trust me, okay? Trust me. Keep doing it, and it'll make sense. And it's actually, the calculations are actually very easy. So here's from the 7th edition, mid 2012 stock price of Intel, about $27. In the mid 2012, their earnings per share were $2.31. And over the past 5 years, the average PE was 17.1. Now, the analysts, or we, or Valueline, or Intel itself, says, you know what, we think the earnings are going to grow next year by 7.6%. So how do we do this? We take the historical PE ratio and multiply it times what we believe the earnings per share are going to be a year from now. So we take the 5-year average, 17.1, multiply it times $2.31, which is the current earnings per share, and then multiply that times 1 plus the growth rate, 1.076. You see how we got from 7.6 to 0.076? 0.076, yes. And do the addition first. Don't do the calculations in the order without doing what's inside the parentheses, or you won't get the right answer. So 17.1 times 2.31 times the quantity, 1.067, is $42.50. So if indeed the PE is 17 next year, the earnings grow by 7.6%, and the stock follows that growth, we expect the price to be $42.50. Cool. Okay, so let's take a look at the next one. The price to cash flow. Well, it's exactly the same formula. Instead, you just use price to cash flow instead of price to earnings. You take the cash flow per share in mid 2012, which at the time was $3.65. How could the cash flow be more than the earnings? Well, as we said, companies that have massive depreciation like Intel, because it cost them $1 billion to make the first chip, and then it cost them a couple bucks to make all the other chips, have tremendous depreciation. So their cash flow is higher than their earnings per share. And if you go back the last 5 years, their price to cash flow ratio is 8.00. And the analysts or Intel or Valueline say, you know what, next year we expect the growth to be 7%, 7.0. So you do the exact same thing. You take the historical price to cash flow ratio, you multiply it times the current cash flow per share, and then multiply that times 1.07, 100% plus 7%, that's basically what you're doing. 1.07, make sure you do the addition first. And that tells you they believe the stock is going to be $31.24. This is far from the price to earnings estimate, isn't it? Yeah, what's going on here? And now, how about the price to sales? Slide number 14. Same thing, folks. You're going to do the exact same thing. Instead, this time you're going to use sales instead of earnings or cash flow. So in mid-2012, the sales per share were $9.99. The 5-year average going back was 3.00 price to sales ratio, and they believe the sales are going to grow by 4.5%. So the expected stock price is equal to the historical price to sales ratio times what we believe the sales per share are going to be next year. And that's 3.00 historical PS, price to sales ratio, times the current sales price, the current sales of $9.99 times 1.045, and that gives us $31.32, which is closer to the price to cash flow prediction. Reality check. Can we reasonably assume that the formulas on the previous slide will give us realistic figures? Well, for many companies, yes, and for many companies, no, but there are countless other factors at work. It is like trying to predict the weather, only worse. The major assumption in these models is that the price multiples will remain constant. However, we are using averages without taking into account the variances and standard deviations of the averages. Remember them? Is it reasonable to expect predictions from these models to be accurate if the variances of the averages are large? No. Well, it depends the company. For the record, the price of Intel 1 year later in mid-2013 was around $24, $3 less than what it was mid-2020, 2012, and far from what we predicted. Check out the previous editions, the third edition. The predictions for the next year were $19.61, $27.54, and $31.63. And the actual price was $33.50. The fourth edition, $50.84, $43.49, $40.92, and the actual price was $17.50. That was not good. The fifth edition, $24.47, $25.36, $29.63, $20. And the only one that was anywhere near close was the sixth edition, where it was $20.92, $20.29, $22.71, and the actual price was $20.50. The only predictions that were anywhere near close were the sixth edition. Doesn't give you much confidence, does it? Well, take heart. The predictions from Disney from the book were much closer to the actual prices. The moral of the story is, I don't really think too highly of the price models. For some companies that have predictable earnings, yeah, they work okay. But for companies like Intel, where you just don't know what's going to happen the next year with regard to the sales and the price to earnings ratio and all those other things, no. But we learn how to do them anyway, because first of all, they're easy. And secondly, they just give us one piece of information. They tell us what, one piece of information that we could use in our arsenal. But take heart, dear students, because when we come back, we are going to learn some techniques that I think, my humble opinion, are absolutely awesome. And these consist of what are called the dividend discount models. So we'll see you in our next presentation, where we begin to enter the inner temple of the dividend discount model.